Hey, everybody, we are seeing some great opportunities in the market, especially when it comes to dividend stocks. We're going to dive into a couple of our favorites in just a second. Before we do, please take a minute and check out the link you see on your screen. You can get the top 10 stocks to buy right now from our sponsor, The Motley Fool, and it's the best way to support this work we're doing on YouTube. So I'm joined with Tyler. We're seeing some good bargains in the market in the dividend category. Right now, the S&P 500 is hovering around an all-time high. Even the Nasdaq overtook its all-time high earlier in the past week. So we'll start with Tyler. Tyler, what dividend stock is on your radar right now?
Well, this is one I've owned for a long time and one that I plan on owning. And in terms of when to buy, this seems like one of the more attractive times. It's Enterprise Products Partners, ticker is EPD. I should clear the air first. This isn't really a company. This is a master limited partnership. And as a result, it's a little bit wonky when it comes to tax purposes, things like that. You get a K1 tax form at the end of the year because you are responsible for your portion of the income tax or business tax for this company that you pay at your sales tax rate or your income rate. Excuse me. As a result, it does not play nicely in retirement accounts and IRAs and things like that. So if you don't have a brokerage and you only invest in a retirement account, this is probably not the best idea for you. But if you have a brokerage and you don't mind a little extra paperwork, this is a company that, or a partnership that has a 7.3% dividend yield today, which over its little bit more than 25 years in existence is one of the, outside of the great financial crisis and the pandemic kind of crash in 2020, outside of that, it's one of the highest yield opportunities that this company has had. They are a pipeline company, and infrastructure. So basically, anything that moves oil and gas. In particular, they focus a lot on what are called natural gas liquids, propane, butane, a lot of the kind of products that we use for either like barbecues or, more importantly, petrochemicals. So a lot of natural gas liquids are used for plastics and a lot of the other things that we, transform into petrochemicals over in mostly down in the Gulf Coast because they actually own several petrochemical refining facilities themselves. So it's a relatively steady business relative to the rest of the oil and gas industry, which is quite cyclical. Pretty much everything they do is on a volume basis rather than on a commodity price basis. There's very, very little commodity price exposure in this business overall. I think more than 85% of their business is done on contract fees, which is all volume. And so you get this kind of level of steadiness that you don't normally see in an industry like oil and gas from pipelines. What has kind of been attractive to me in particular about Enterprise Products versus other pipeline companies, because what I just said explains like 15 other companies that are publicly traded. What makes Enterprise Products that much more attractive is that management at the company have been very, very good stewards of shareholder capital. Haven't taken on too much leverage. There's not a lot of debt on the books for a pipeline company relative to some of its peers that have had to cut dividends over time because of too much leverage, or maybe was growing too fast and was a little bit short on cash. It's a company that has always been very conservative in how much they pay out, and it's left them with the ability to even buy back stock, which is quite a rarity in the midstream space. You don't see a lot of companies actually doing that. It's not a company anyone should expect a lot of growth from. The actual share price itself is barely moved, I think, in probably the 7 or 8 years that I've owned it. But with a 7.3% dividend yield, it's actually 7.5 on the forward payment because they've just had a recent dividend raise. When you have that much of a dividend and it's grown 4% annually over the past 10 years, you have a pretty good return just from your dividend. Not anything that's going to knock your socks off, but if you're looking for very reliable income that's going to grow at a decent rate, that's a decent return over a very long haul. Something that's been very powerful for me is, owning something like this and automatically reinvesting those dividends. That can actually generate a pretty good return over 10, 20, 25 years.
I like that one. I'm going to talk about one that doesn't have quite as high of a dividend yield. It pays about 4.5% right now, and it is Mid-America Apartments. Ticker symbol is MAA. So Tyler follows real estate just like I do. He's a little more versed in energy than I am, but we're both good real estate, analysts. So one thing that you have to deal with over time in any subset of real estate is supply and demand dynamics. In certain areas, properties get overbuilt. If a property type gets particularly hot, they build a lot of them, then there's too much to meet the demand. You see this a lot in self-storage in particular. That's a very prime example where it's really easy to overbuild. Right now, we're starting to see it in some apartment markets, specifically in the fast-growing areas of the country. The big narrative over the past, say, 5 years has been, okay, there's limited growth in the cities and in the northeast areas and things like that. But in the Sun Belt region, population growth is high, wage growth is high, there's net migration, things like that. And as a result, every developer has been building apartments as fast as they can. So we're starting to see supply really overtake demand in a lot of these markets. And Mid-America's numbers do reflect that. Their top markets, just to give you an idea of where they operate, their top 5 markets are Atlanta, Dallas, Tampa, Orlando, and Charlotte. So Sunbelt markets, they do have above average population growth. That's very true. They have above average household formation. They have above average job growth. And this is one of the biggest players in the space. I think by number of units, they're actually the largest residential REIT in the market. They're very close to it, if not. About 102,000 apartment units. The numbers in some ways look strong. The properties are almost 96% occupied. But on the other hand, their rent is going down. That's not something you like to see from an apartment operator, right? On new leases, they're getting 7% less on average than they were previously. Overall, on new and renewal leases, the decline is about 1.5%. So that is these oversupply issues at work here. 2 or 3 years ago, there were not enough apartments in these markets to meet demand. So you would see rent increase by double-digit percentages year over year, which is kind of crazy for an apartment REIT. But we're seeing that kind of reverse right now. However, this is a temporary issue. Supply and demand will balance out. Mid-America Apartments does not deserve to be 45% down from the highs, which it is right now. And it's in a good position to capitalize on market weakness. Mid-America Apartments is one of the few REITs with A-rated credit. It has favorable borrowing rates. It borrows money at about 5% right now. That's what it's getting on new debt. And we're seeing a lot of smaller developers struggling with being able to refinance their properties right now. It's really tough to walk into a bank and say, okay, I own an apartment complex. I borrowed money 3 years ago at a 3% interest rate. I need to refinance it, but my rent growth is negative year over year. That's a really tough sell to a bank. So a lot of these smaller operators are having a tough time refinancing their properties. And Mid-America is in a great financial position to swoop in and capitalize. In the fourth quarter alone, they acquired 2 properties at what they estimate is about 15% below what it costs to build. And they're anticipating another $400 million in acquisitions this year. So good position to capitalize. Management has a great track record of outperforming. Their 20-year total return is well above the S&P 500. And at about 16 times funds from operations, which is the real estate version of earnings, this looks like a pretty attractive one to add right now.
So one of the things, like I said, we both kind of have been looking at this. And one thing that I have really noted is that multifamily construction in the United States is at a 40-year high. So there's a lot of supply coming to the market right now. And it'll be interesting to see with a Mid-American or somebody like that, where I think there's still going to be a lot of short-term headwinds. And it's like there's probably going to be a longer window of being able to acquire this company at good valuations, because I think the market's going to look at this and go, oh man, rents are going down and all these new supplies coming to the market. But it'll be interesting to see, like you said, because cost of capital is going to be king for a lot of these companies, or a lot of developers who probably borrowed at 3-4% in 2020, 2021, and now all of a sudden are staring down a refinance at 7.5%, 8%. And so, like you said, it could be a short-term headwind that will look pretty gross for the next few months, but at the same time, a very ripe opportunity to build on the business.
Yeah, and I mean, at some point, the supply and demand will catch up to one another, right? You're in a market, just on average, the population's growing at over 1% a year in Mid-America's markets. So a lot of peak household formation years going on right now. The massive millennial generation's entering its big household formation years. They're generally inclined to start out renting rather than buying. There's a lot of favorable dynamics. So at some point, the demand will catch up to supply. It just kind of got skewed the other way in a little bit. But I agree with you that you might have a nice window of opportunity here. I'm not saying you have to run out and buy this in March. I think you're going to get a nice little window of opportunity. But at the same time, if rates start to fall, it could be an upward catalyst for the stock. So it's a combination of, a bad market environment for multifamily and the higher rates that are putting pressure on the stock right now.